What's up, everybody? We are once again going to be talking about Elevance, ticker symbol ELV today. This week, YouTube recommended me this 3-year-old video where Monish Pabrai says Meta Platforms is an easy double. This was posted in February of 2022, and at that time, Meta was about $200-ish a share, and the stock has certainly more than doubled since this video was made, although not before it cut in half. The stock dropped by another 50% first, and then it's had this incredible run. In any case, I got to thinking, what do I think is the easiest double in the stock market today? And that's what this video is going to be about. None of this is advice to buy or sell any stock. And when I say easiest, it's just relative to other stocks. I don't think any stock is an easy double per se. If it was so completely obvious that a stock like Elevance should double over 5 years, then the stock price would likely be higher today. The market would recognize that. So people are going to have different opinions. This is just my point of view. Keep in mind, individual stocks are incredibly volatile. Yes, Monish Pabrai did predict that Meta was going to double. But you know what? After this interview, again, the stock price cut in half, went from $200 to under $100 a share. There were a lot of people who were saying, yeah, you don't know what you're talking about. So in the short term, over the next year, will Elevance stock be significantly lower than it is today? Maybe. I don't know. But I'm going to explain why I think over the next 5 years, this stock is going to be significantly higher than it is currently trading for. If you get value out of the video, subscribe to the channel. We passed 3,000 subscribers last week, so thank you so much to everyone who has followed. A lot of you have asked where you can get my Google Sheets, where you can make these sheets yourselves, and I am so excited to announce that very, very soon you will be able to download my template and make your own spreadsheets. It's going to be very simple. All you will do is put in a ticker. Let's say we want to look at UNH, and then I'm just going to hit load. And now you're going to wait a moment and the sheet is going to do its work. We already see the price history for UNH right here over the past few years. You see our data starting to be pulled into our table right here. And in just a moment, the data is completely here. We've made some nice looking charts for UNH. I'm going to switch this back to static so it doesn't keep trying to pull data. We can see UNH's free cash flow yield, their price to earnings ratio, operating margins, all these things. And if you just want to quickly make some assumptions about the future, their revenue maybe is going to grow 8% every year for the next 5 years. Operating margin, you think maybe it's going to recover to 8%, and their free cash flow margin is going to be about, 5. And then if you think they're going to trade for a multiple of 10, you would see that based on these assumptions at the price today, you are looking at a 17% annualized return on this stock. So that's more than a double over 5 years. I'm very biased here, but I think that this is an incredible tool. It will only be available to people on Patreon first. Now, the reason it is not up yet is I'm using my own add-on to pull this data into Google Sheets. The add-on is called Deep Value Hunter, and as soon as this is approved by Google Marketplace and this is available for people to get, then I will open my Patreon because I want this to be ready so people can have this when they join. Once you have the add-on, you'll be able to get this template that I have right here by just hitting Get Template. I just realized this is probably cut off a little bit. Okay, there we go. Now you can see the whole thing. You will need to get an API key from me for this to work. In the beginning, API keys are going to be limited to Patreon members. But if you become a Patreon member, you'll just be able to go to my website, deepvaluehunter.com, put in your email, put in the access code that you're going to get from Patreon, hit sign up, and you'll be emailed your API key and you can start using this add-on. And then I think I made it pretty user-friendly. Just put in the ticker you want to look at. Let's say you want to look at Intel, and you're going to hit load to load new data. Just give it a moment for the add-on to populate your sheet and to make these graphs for you. And you can instantly see Intel's revenue roughly the same today as it was 15 years ago. Their margins have slid, fallen off a cliff. So this is coming to all Patreon members. As soon as this add-on is approved, I will open my Patreon. I will announce it here on this channel. I think it's incredibly useful. Now let's get back to this video. Let's get back to Elevance. If you follow this channel, you know that I am very bullish on these health insurance companies. A lot of them have sold off massively this year. I do own Elevance. I also own UNH. I own Centene. I think they're all cheap. I've made videos on each of these companies, so I won't go into depth here. But all of these companies have significantly underpriced their health insurance plans for this year. Costs are significantly higher than anticipated, and that has compressed the margins across the board. All these companies, their margins are down this year. These companies are targeting different subsegments of the health insurance market. UNH, first of all, the biggest player, followed by Elevance and then Aetna. Aetna is owned by CVS. These three really targeting employer-sponsored plans, which relatively are a higher margin and I would consider slightly lower risk segment of health insurance. Now, Elevance in particular has higher exposure to Medicaid than UNH and CVS, lower exposure to Medicare. This past week, the Elevance CFO was speaking at a conference and he said Medicaid costs are going to be high this third and fourth quarter. Yes, we underprice our plans, our rates are low, costs are going to be actually a little bit higher than we thought. So this caused stocks with exposure to Medicaid to sell off pretty significantly on the 4th. Both Elevance and Centene, I think, were down about 4% that day. In spite of this, the CFO reaffirmed their 2025 guidance for $30 in adjusted earnings per share. They are trading at roughly 10 times earnings, and these are depressed earnings. This is after their margins have pulled back significantly. The crux of my thesis for all these health insurance companies is they are going to reprice their plans. If you listen to the conference calls from Elevance, UNH, Centene, Molina, all of these companies, you listen to what they're saying rates are going to go up. Medicaid, Medicare, Marketplace, employer-sponsored plans, the rates for all of these things are going to increase. If you work for a company and you have employer-sponsored health insurance, ask your employer, what are rates going to look like next year? How is my health insurance payment going to change? And they'll probably tell you that you're going to be looking at an increase in your health insurance rate next year that is perhaps a bit larger than you've expected in the past. But here's the thing with health insurance, they cannot fix their rates on the fly. They can't just today decide that they are going to increase the price for health insurance in Q3 of 2025. It doesn't work that way. The premiums that people are paying for this year, they are already in place. They're locked. They're going to reprice their plans for 2026. Next year, they're going to reprice their plans for 2027 if they need to. To me, it is about as close a thing to a certainty as I think you can get that the demand for healthcare 5-10 years from now, it's going to be greater than it is today. And the pressure that these companies are under on their margins, I think that it is mostly temporary. You have had some bad years in the past. They will reprice their plans. Now, when I say temporary, it might feel like a long time for some investors, because I don't think you're going to see improvements in the margins of these companies until at least Q1 2026, which won't be reported until, April, May for a lot of these companies. But the writing is on the wall. These companies are focused on margin and profitability for next year. Now, the reason why Elevance in particular is my largest holding in this sector and the company that I would pick for the easiest double over the next 5 years is because this is a very large diversified player. Their exposure is spread out over a bunch of different subsegments. I think Centene and Molina both look cheap as well, but they have heavy exposure to Medicaid. To me, that increases the risk of Molina and Centene. Also, Elevance has a fairly significant health services side of their business too, along with a pharmacy benefits manager, also called a PBM, which is Carelon RX. They are trying to consolidate insurance with the rest of the healthcare value chain here, kind of along with UNH. UNH has Optum, Optum RX. So Elevance definitely following the UNH playbook. And while I own UNH, the reason I'm picking Elevance here is it is even cheaper than UNH without a lot of the headache. You don't have a DOJ investigation and you buy Elevance today at a lower price relative to the fundamentals. Just for a quick back of the envelope calculation, Elevance and UNH, both, roughly a similar share price today. Elevance is predicting about $30 in adjusted earnings per share for this year. UNH, it's in the teens. So while I like them both, Elevance is cheaper. You know who else thinks Elevance is cheap? Their management. The CEO, Gail Boudreaux, bought 8,500 shares a couple months ago when it was under $300 a share. Recently, another insider bought over 1,000 shares, about $400,000 of stock. This was less than a month ago. Now, let's go back to our sheet. Let's see what we can expect for a return on our investment in Elevance today. I've not changed my assumptions about the future since my Elevance video. I think these are reasonable assumptions. My base case, I'm looking at 7% revenue growth annualized over 5 years. This is lower than they have been, and I'm assuming operating margins just get back to 6%, which would be on the low side of where they have been historically. I'm assuming free cash flow margin remains on the lower side, just 2%, and I'm giving them a 12 times multiple. This is not a crazy valuation. Personally, I expect the company to hit these numbers. And in this scenario, at today's price, you're looking at a 24% annualized return over 5 years. That is close to a triple on this stock over 5 years. Now, my bear case is essentially the, this is a structural change in health insurance moment scenario. Health insurance companies will not fully recover. We are looking at a new normal. Operating margins are going to remain low. I'm assuming no recovery in their profitability. I'm giving them just 4% revenue growth, no free cash flow for the next couple years, and only a 9 times multiple after 5 years. And even in this scenario, you're looking at a 4% annualized return on this stock. I think I've painted a really pessimistic future of Elevance with these numbers, and you are still looking at a return that is, the same as a money market fund today. You're not losing money on Elevance if the assumptions that I put in here come true. Now, there's always risk. There's always going to be things that we can't predict. Might, Congress have some new regulation about PBMs, or maybe the administration tries to do something that's going to significantly affect Elevance's business. I don't know. I feel like even if my thesis is wrong about Elevance and health insurance, and even if the super pessimistic scenario comes true, I just don't think I'm losing a lot of money at these prices today. That's just my opinion. And if Elevance fully recovers, if you look at, like business as usual, 9% growth on the top line, which is basically where they have been, margins fully recover, 6.5%, give them a 15 times multiple, you're looking at a 35% annualized return on Elevance stock. To me, the risk reward on Elevance is one of the best in the stock market today. I don't know if there is such a thing necessarily as an easy double, but if you force me to pick one stock that I just think is the easiest double in the market, yeah, this is my pick. It's Elevance. So let me know your opinion. If you had to pick what you think is the easiest double in the stock market today, let me know what that stock is for you down in the comments below. If you agree or disagree with anything I said here, leave that down in the comments as well. If you got value out of the video, subscribe to the channel. And again, really soon, I hope that you support me by joining on Patreon and grabbing this, what I think is a really cool template and plugin for Google Sheets to analyze stocks. Again, as soon as the add-on is approved in the Google Marketplace, I will be releasing my Patreon and I will let you know on here. So thank you for watching, and I hope to see you all in another video.